Welcome back, Alpha Hunters. So I'm going to break down, is gold a good investment, or is gold maybe a better investment than maybe the S&P 500, okay? Maybe compared to stocks in the stock market. And we're going to be looking back through several decades of data to kind of get an idea of how gold and the S&P 500 have moved and how they have performed against each other. So I'm going to be using TradingView, and I'm really going to zoom in here, and I'm going to get rid of some of the older data before 1971 just because it was kind of old, and I want to focus on the data that is really good in here. About 50 years of data. This will get us a good enough idea of what we want to accomplish. So here we have the price of gold, and it has done very well over the past, roughly 53 years of data here. But you can see that it hit a high back in 2011 and really hasn't gotten above it. It looks like it is ready to probably move higher. Kind of couldn't fault you for saying, hey, you know what, I kind of want to be bullish on gold here. It looks pretty good technically. But I'm going to go ahead and overlay the S&P 500. And what you can see, since I've overlaid the S&P 500 on top of the gold bar chart here, is the SPX, or the S&P 500, has underperformed since roughly 1970. Okay, so it's underperformed a little bit. I'd say there's probably two areas where there was major underperformance. Is probably right here in the 2009, 2010 type area, and then back over here in 79 and 80. So what I want to do now, just to get a better understanding, is do a ratio, okay? And the way I kind of like to do ratios is I like to do the S&P 500 first. So I'm going to do the SPX divided by gold. And what we can see is there was definitely some outperformance periods for gold over the SPX. Now, since I did the SPX divided by gold, anytime there's an up move, that means the SPX or the S&P 500 was outperforming. Anytime there's a down move or a downtrend, that means gold was outperforming. So back in the 70s, early 70s, late 70s, gold was outperforming over the S&P 500. Here in the mid 70s, 75, the S&P 500 was outperforming. And then from that bottom in 80 all the way up to pretty much, you can say, 2000, the S&P 500 was outperforming. So that's how you kind of understand how this chart reads. And you could say from 1970, they're roughly performing about the same over that period of time, because we're pretty much at that same relationship price level we started out at. Now I'm going to throw in a couple more wrinkles into it, okay? So I don't think we've really got conclusive enough evidence of maybe what we would want to do. And really, I would say from where we are right now, you really probably couldn't lean one way or another, just because, we're kind of in the middle. We got the lows below us, we got the highs up above us. So there's not really too much evidence that we would be buying at the lows or selling at the highs. So I'm going to throw in this little wrinkle. So the SPX and gold, neither one of these can pay dividends. We all know this, gold cannot pay a dividend. But what I want to bring up is the SPY. Now the SPY, the SPY, is an ETF meant to mimic the S&P 500. So this is the SPY divided by the SPX. So the relationship should be pretty flat, and it is. You can see it pretty much hovers around the 1.0 line almost perfectly. And there should be some variation a little bit across some of the months, but it shouldn't deviate over longer periods of time. There just might be shorter term market fluctuations as they don't line up perfectly, certain little market nuances. And the SPY, the ETF that's meant to mimic the S&P 500 or the SPX, actually started trading in 1993. So there was no data before then. So we're only going to be analyzing the data from 93 to now. But one thing I want you to understand here is we are comparing the SPY and the SPX, okay? And the SPY actually pays a dividend. They pay a quarterly dividend, and it's not the best dividend ever, but it is a dividend. And so if I hit this adjust data for dividends button, you can see the chart changes, and it now goes from a bottom left to the top right. So if you ever want to know, does the SPY outperform the SPX? Well, if you turn on the adjust data for dividends button, yes, it does. Because if you invest in the SPY, you will get those quarterly dividends. The most recent date should always be near 1 if you look at this chart with adjust data for dividends turned on. So this is a very interesting chart to see because it now changes your investing dynamic. So I went ahead and brought back that chart of the SPX divided by the gold. And you can see we had that big run up in the second half of the 90s up to the .com top. And then we basically had that drop off where gold outperformed for much of the 2000s. And then the SP 500 has been steadily outperforming since 2011. The thing I want you to notice here is watch this little consolidation area that we had back in 2002 to 2006, where we kind of just went sideways. Basically, the ratio between the SPX and gold stayed roughly the same. And notice where the price is currently relative to that spot. Now you can see that I just loaded up the SPY divided by gold, and you can see the current price of the SPY versus gold is higher than that consolidation period back from 2002 to 2006. So basically what this is telling you, if you were to take a long-term approach to investing and you invested in the SPY or some other kind of market diversified ETF, like the VOO is also another one. And whenever you got your dividend, if you would reinvest those dividends back into your asset, like the SPY, you would actually be better off in the long run. Now, there are time periods in history where we have seen the S&P 500 and its relationship to gold get a little bit too imbalanced. And in those situations, I would say, yes, maybe it is a good time to maybe peel back some on stocks and maybe go a little bit into gold, kind of like what we had at the top of 2000. But we are not anywhere near those kinds of levels on the relationship of the S&P 500 and gold. And therefore, I would just say stick with the S&P 500, the SPY, or the VOO, and just reinvest your dividends. And you will be outperforming really both of these assets, the SPX and gold. Now, if you were going to invest in gold, there are really 3 ways you can do it. One, you can buy the physical asset of gold and hold it. I would not recommend that because it can get lost or stolen, and then you're just out your value. The second way is you could invest in futures of the commodity, but I wouldn't recommend going this route either because futures contracts expire and then you got to do rolls and it's just more to manage, and I wouldn't really go that way either. The third way, and the way I would go, is by using the GLD. And you can see here the GLD is the Spider Gold Trust. So basically they are just an ETF that basically buys and they store gold at their storage facilities. But the GLD trades like a stock, so it's much easier to get in and out of gold positions going this route. You also notice the GLD is not nearly as expensive as the gold price. The gold price was roughly, at the time of recording here, was roughly $2,000 an ounce. And here the GLD is currently priced at around 181. So for most of the time, I would actually just stay invested in SPY and reinvest my dividends back into the stock, except for maybe some times where the relationship between the SPX and gold gets a little too bloated or inflated. And in those times, I would actually maybe scale back some SP 500, maybe into gold, and understand that if you're doing that it might take years to see maybe the market turn across both asset classes for you to start to see some benefit. And that is why I highly recommend just staying invested in SPY or the VOO or some other low cost S&P 500 tracking ETF and just reinvest the dividends. Alrighty, take care, Alpha Hunters.